Greetings after a brief hiatus, fellow financial independence seekers, and welcome back to Trade in Your Job with Matt. Today, I'd like to touch on asset allocation, rebalancing, and overweighting or underweighting asset classes or sectors using annual returns to drive tactical allocation decisions. This will not involve forecasting anything to happen without a doubt, just examining what's happened in the past and how we can use it to our advantage for the future. We'll look at historical data going back to 2008 for asset class returns, as well as the returns for the 11 S&P sectors since 2008. This information can help any investor as it deals mostly with investing psychology. This rebalancing and tactical allocation strategy is for long-term investing in accounts with core holdings. It is not for short-term trading decisions of individual securities. It can be utilized by those still accumulating assets, or for those that are no longer in the savings phase and instead in the distribution phase to make portfolio drawdown decisions. This can be used in an employee retirement plan, health savings account, IRAs, or taxable accounts, so it is very versatile information. Asset allocation just means how much money you are going to allocate to each asset class, and it is typically expressed as a percentage. For example, if you picked 4 investments and devoted 25% to each, that would be your asset allocation. I usually think of asset allocation across your entire portfolio, including all accounts. You don't have to recreate the same portfolio and allocation in every account. It usually makes sense to hold different things in different types of accounts because of the tax treatment. Rebalancing refers to selling gains in your top performing asset classes and using the proceeds to buy your underperforming asset classes, which will bring your portfolio back to original target allocations. It does not mean you're going to sell 100% of any asset class, just that you take your gains from your winners to reinvest in other asset classes and reset your risk. And I am not talking about doubling down on losing positions that are not long-term holdings, such as individual stocks or over-the-counter stocks. This is for core holdings. Overweighting or underweighting means anything outside of the weighting given in the total market index. Since the total market index is something you could buy and own everything, then if you stray from a total market index, you have already overweighted or underweighted certain asset classes, whether you meant to or not. For example, if you own the total stock market index pictured here via the FinViz total market, but you also bought shares of Apple stock, that would be overweighting Apple because it is already the biggest component of the total stock market index, and you also bought more of it by buying Apple stock directly. Overweighting can work to your advantage if that stock or asset class outperforms the overall index moving forward, but in this example, if Apple struggles in the coming years compared to everything else in the index, you would underperform the total stock market index because you overweighted Apple, and it had a smaller return compared to owning everything else at a higher percentage. Underweighting is the opposite of that. That's if you bought certain sectors or asset classes individually instead of a total market index, and you underweighted or gave a smaller percentage to some asset classes than they receive in the index. So pictured here are the 11 sectors year to date from the S&P. If you underweighted the sectors at the top, you would be underperforming because the sectors at the top have the highest year to date percentage. If you're feeling confused at all, this will make more sense momentarily. There is a fantastic website with lots of information at novelinvestor.com with some great resources that I will be referencing today. I've linked it in the description in case you would like to check it out for yourself. I appreciate that they took the time to make it so that I could share it with you. The charts we will be looking at are interactive and color-coded. This makes it visually easy to identify trends or volatility. To orient you to this chart, the columns from left to right are for the years, and the rows from top to bottom are for the best performance to the lowest performance, and the year-to-date performance is in the column to the far right. Looking first at the returns of global asset classes, there are 8 different asset classes and 1 asset allocation fund, which is a combination of 6 of the asset classes. And there is an asset class key at the bottom, which tells you which are which. You've got large cap in orange, small cap in light blue, international stock in dark blue, emerging markets in purple, REITs in red, also called REITs, high grade bonds in green, high yield bonds in brown, cash in yellow, and asset allocation in white. The asset allocation portfolio is 60-40 stock bonds overall, broken down as 15% large cap, 15% international, 10% small cap, 10% emerging markets, 10% REITs, and 40% high-grade bonds with annual rebalancing. The asset allocation portfolio excludes high-yield bonds and cash. What do we notice about the chart that can help us with long-term investing decisions? I've talked before about performance chasing. This chart is a great illustration of the pitfalls of overweighting top performers. The top performing asset classes from one year can end up at or near the bottom of the next year. If you keep repeating this cycle of overweighting top performers, it can be a recipe for blowing up your account. As expected, the asset allocation portfolio hovers around the middle rows. This makes sense because it is a 60% stock, 40% bond portfolio overall, so it should really never be the top performer or the bottom performer. It's minimizing big swings in both directions that makes it more of a balanced approach. It can be easier to stomach for many investors due to the reduced volatility, and this is why so many long-term investing approaches include a 60-40 portfolio allocation for comparison. It is interesting that of all the different types of markets humans buy things in, the stock market is the one where psychologically many people fear a sale. They will avoid buying asset classes that are performing poorly, and instead they chase the asset classes already overperforming. And this, I guess, lends itself to fear and greed. We get greedy with gains and fearful of losses. And I like to think of these trends as what asset classes should I be accumulating and what should I be selling to rebalance my risk? Cash does spend most of its time as a bottom performer, and this chart was during a time where interest rates were so low that cash was hardly returning anything in terms of interest. There were still some years that cash was the top performer, so it is a good reminder that cash is a position too, and that accumulating cash or savings to invest in downturns can be helpful, especially now that at the time of this recording, cash is paying around 5% for most money markets, which act as your sweep position in your brokerage account. I imagine we see cash as a better performer if rates remain elevated and the cost of borrowing remains elevated. I also think that high yield bonds deserve a place in the portfolio as well. Many think that high yield bonds are so similar to stocks in terms of risk, you might as well just allocate more to stocks instead of buying them, but we can see that in some years, high yield bonds have outsized returns, and they do behave differently than domestic stocks. So I think an allocation to them in a tax-advantaged account is prudent for many. I would consider them to be part bond, part stock for the allocation, so maybe 50-50 stock bond when you're thinking of high yield bonds because they are higher risk compared to like investment grade bonds, and they can carry similar risks to equities. Overweighting large cap stocks, meaning the S&P 500, during the last 15 years would have led to good outcomes most years as it spent more time above the middle dividing line on the chart than below. This makes a lot of sense as US growth has outperformed in an era of cheap money, but will it continue to do so? If you zoomed out to a chart of decades of performance, my guess is that we would see decades of overperformance followed by decades of muted performance because those also go in cycles. Pictured here are international stocks, and I know that those aren't as popular with a lot of US investors, but you can see that they would definitely have helped your portfolio a lot of years. When looking at emerging markets, the first thing you'll notice is they can be extremely dynamic. So in the years that they are bottom performers, that seems like the time to consider adding them while taking profits on the big moves up. Looking at the year-to-date performers so far, bonds, REITs, and high-yield bonds are at the bottom. This makes the most sense since these are all interest rate sensitive and there have been extreme hikes this year. So based on what we've talked about so far, guess what I would be adding new money to or considering rebalancing into? Switching gears now to just focus on the S&P 500 sectors, here's a breakdown of the 11 sectors that make up the S&P 500. So you've got consumer discretionary in red, consumer staples in brown, energy in green, financials in blue, healthcare in purple, industrials in dark blue, information technology in orange, materials in yellow, real estate in light pink, communication services in teal, and utilities in dark pink. And the white is just the average of the 11 sectors. What you'll notice is that similar to the returns of the global asset classes, outperformance often leads to underperformance. So in S&P terms, this is often referred to as sector rotation. It's where money flows out of one sector and into another. So how can we use this information to improve our returns for our domestic equity allocation? Usually, chasing the high performer does not lead to better returns the next year. Energy seems to be the most dynamic in terms of either worst performing or best performing. So if you bet it all on energy one year, it could be a wild ride. Utilities have also spent their fair share of time in the lower third of the rows. They are typically a defensive position. Tech has spent much of its time in the top half over the last 15 years. Will this continue? The AI craze would seem to suggest so. Let's now think about making our own asset allocation and rebalancing. Rebalancing can be on a set schedule such as monthly, quarterly, or semi-annually. Some also rebalance based on risk bands, meaning when a target allocation strays from the target by more than 5% or so, it's time to rebalance. It's psychologically difficult to do, But at the end of the year, or whenever your rebalancing time frame is, when your top performers are up and it seems like nothing can stop your winners, that is exactly when you need to sell the asset classes that are winning and rebalance your gains into the asset classes that have lost the most. It's easier said than done. Just look at the visual evidence right here in front of you. You can see that overweighting winners going into the next year typically leads to losses or underperformance in most cases, and that underweighting losers would lead to missing out on some impressive rebounds for the following years. I think the key takeaway is that you will buy things that will continue to go down for a time, and you're definitely going to sell things that will continue to go up. Rebalancing can definitely feel like missing out in the moment. However, good risk management of your portfolio involves rebalancing into asset classes or sectors on a set schedule that will help your account grow over 20, 30, 40 years while also minimizing risk of major losses. As your account grows, the risk of chasing also grows as your contributions will no longer be able to make up for significant losses like they can when you're just starting out. Well, I think that about wraps up my thoughts on this topic. What are your thoughts on tactical asset allocation? I'd like to hear if you practice this already or plan to incorporate it in the future. Please let me know in the comments. As always, thanks for watching. Till next time.